And so one thing I've been pointing out for years is that you can have a multipolar world where, Chinese currency is kind of the main currency over in East Asia. The United States is dollar is, the currency in our hemisphere and other parts of the world, and Europe's is kind of, their part of the world and their biggest trade partners in periphery. So you can have kind of three currency blocks of different sizes. You can have an elevation of neutral reserve assets. So he specifically calls out that this plan would be good for gold and cryptocurrencies over time. Funding currencies that are cross-border can shift a little bit. There can be different incentives to maybe have the world shove less of its asset flows into U.S. assets and instead buy things like gold or Bitcoin or potentially some other assets from other countries and kind of diversify this to some extent. I can imagine the administration's challenge of trying to communicate this because the intricacies of how trade deficits and the reserve currency kind of pair together is very wonkish. It kind of has this academic quality to it that doesn't go over well in kind of political oriented speeches. I'd be terrible at a political rally, for example, when I try to explain any of this. And so we kind of have this situation where, and this was outlined back during the Bretton Woods system by Triffin, as you mentioned, which is that having the reserve currency does come with a bunch of benefits. Is historically called a exorbitant privilege, but then it has certain costs to maintain it. And those costs can vary a bit depending on how the system's structured. So, for example, back in the Bretton Woods era, the cost was that we kept draining our gold reserves. We basically had to kind of keep paying out our gold reserves to maintain that part of the system. And in the current formation, instead, we kind of pay for it with our industrial base. We keep kind of sending out little parts of our industrial base over time to maintain the global reserve currency status. And there's a few reasons for that. One is that because unlike every other fiat currency, the dollar has all these extra demands for it by countries all around the world. All these different purposes, there's this extra demand for dollars, which sounds good on the surface. And as for Americans, for example, we have tons of import power. When we go on vacations to the rest of the world, we have pretty strong purchasing power compared to when they come to the US. These things seem good on the surface, but it also means that it's pretty expensive to manufacture lower margin things here at home. And so we have this kind of situation where our imports are very strong. Our exports, especially lower margin stuff, is less competitive, whereas we can still be competitive on really high margin stuff, technology, finance, healthcare, that kind of thing. And then the other aspect is that even if you could somehow solve that, there's a more fundamental problem, which is that the whole world needs dollars for the global reserve currency status to use it for international contract pricing, cross-border financing, one side of every trade pair that they do, all these different purposes as a reserve asset. And when you step back and say, well, how do they get all those dollars? If they're all using dollars, how did all those dollars get out there? And the answer is trade deficits. Basically, that overvalued aspect forces open the U.S. trade deficit. And every year we send out hundreds of billions or sometimes a trillion dollars in net outflows. And over years and decades, these have accumulated out there. And so kind of the way it works is that if you want to fix the trade deficit, which I've been writing about since 2019, I think that's a valid mandate to do. Unfortunately, it does come with trade-offs. Some of the benefits that we enjoy at the cost of the trade deficit, if you do want to kind of fix that imbalance, it comes up, with basically giving away at least some of those benefits and prioritizing that industrial base a bit more. And so basically the opposite side of a current account deficit, which is basically the trade deficit plus things like interest and dividends. So we run a structural current account deficit, and the opposite side of that is a capital account surplus. Which is that funds flow in the rest of the world and buy our financial assets. And so the trade deficit is often described as us sending out pieces of paper and getting goods and services, which sounds like a really good deal. But then the extra step of that you mentioned is that they take those slips of paper, or really those electronic digits that they have, and then they buy our stocks, they buy our real estate, they buy our private equity, they buy our corporate bonds and government bonds. And so they end up owning a larger and larger share of corporate America as part of their kind of accumulated trade surpluses and reserve assets and international private assets. The consequence of this, if you kind of view the foreign sector as an intermediary, we're basically constantly kind of taking economic vibrancy out of Michigan and Ohio and rural Pennsylvania where the steel mills were. We're kind of taking it out of our Rust Belt causing it to become the Rust Belt. And then we're stuffing it back into financial assets in New York and Silicon Valley and certain other places, mainly along the coasts. And this went on for approximately four plus decades, really ever since you can say kind of the early 80s. This really kind of started, and these are cumulative. So 1 year of that is not a giant deal, but when you have 4+ decades of it, that causes major imbalance. And a lot of academics will say, well, there's still room to go. This is not kind of an emergency. But on top of that, there is this political overlay that basically that voters get angrier and angrier when they're on the wrong side of that imbalance. And although many of them, they don't work in finance, they might not be able to articulate the exact mechanisms that are causing it, but they have this feeling that something's rigged against them, that something is just not right, that they're constantly going uphill, that they're on a treadmill. And so we start to see this it manifests in rising voter populism. It manifests in different priorities when people vote. And so I do think that there's a pretty strong mandate to try to go after the trade deficit. But I think the way I look at it is that because it's decades in the making, the best that any kind of one term can do is try to, start changing the direction of it. But it's inherently kind of a multi-year, potentially multi-decade project to kind of fully reverse these really long-term trends. I think I would separate into three things. One is kind of the mandate, two would be the plan, and three would be the execution. And I think the issue is that they start off good and then they kind of deteriorate as you go through those three steps. I think the mandate is there. So there's some people in politics that would disagree that the mandate's even there. They say we shouldn't be going after the trade deficits or they're not a big deal. I disagree with that. I do think that, and I've been writing about this for years, that the imbalances have become big enough that they're actually starting to really matter. Financially, politically, they're actually a big deal now. And if you don't ever focus on addressing them, given the network effects involved, eventually it forces itself closed anyway, but that's from a position of weakness. So it's better to kind of get ahead of it before it's kind of fully metastasized and there's really no options left. You generally want to try to correct it from a position of strength. So I do think that there is a genuine rising mandate to reverse some of these multi-decade flows that are basically all going in one direction. So I think that part is sound. The second part would be the plan. And if you look at probably the smartest version of the plan, it would be Stephen Myron. That's Trump's chair of the Council of Economic Advisors. He's an economist, and he laid out this paper back in November 2024, so right after Trump was elected. And he outlined it was like, I forget the exact title, but it's like basically how to realign global trade. And it's this paper that kind of articulates the problem. So he talks about Triffin's dilemma. He talks about the overvaluation of the dollar due to its uses as a global reserve currency, how the cost of that is basically undermining our industrial base, making us less competitive in manufacturing, and how some of those imbalances where the downside of that system have surpassed the benefits of the system for America broadly. And so he kind of analyzes different ways that this might be addressed, and then also goes over some of the risks of addressing them. Like it's not treated as like a surefire solution, but like if you were to go about this, what are the ways we could do it? What are our options? And they include things like, starting with some mild tariffs, which kind of is like if you treat it like a carrot and a stick, that's the stick. And then when there's kind of multiple mild tariffs on that are somewhat disruptive, that they could do some sort of currency accord, a series of trade deals that are in the United States' favor, that could then bring down some of those tariffs and start to maybe balance out trade somewhat. Then he faces the issue of, okay, well, what's next? What's after that? Because there's still the issue that if you want the dollar to be the global reserve currency, you have to supply the world with dollars. And so he focuses on, well, one, you could give up some of the reserve currency status. So it's not a Boolean thing. It's not like you either have global reserve currency status or don't. It's really a percentage thing. And so one thing I've been pointing out for years is that you can have a multipolar world where Chinese currency is kind of the main currency over in East Asia. The United States' dollar is, the currency in our hemisphere and other parts of the world, and Europe's is kind of, their part of the world and their biggest trade partners in periphery. So you can have kind of three currency blocks of different sizes. You can have an elevation of neutral reserve assets. So he specifically calls out that this plan would be good for gold and cryptocurrencies, which we realistically we mean Bitcoin. He uses the phrase cryptocurrencies. And so over time, funding currencies that are cross-border can shift a little bit. There can be different incentives to maybe have the world shove less of its like asset flows into U.S. assets and instead buy things like gold or Bitcoin or potentially some other assets from other countries and kind of diversify this to some extent. And then there's also various mitigants because if you weaken the dollar, you risk higher inflation, you risk higher bond yields at a time when fiscal deficits and U.S. interest expense are very high. So he talks about as part of trade negotiations, terming out the debt, convincing countries like China or Japan to increase the duration of their treasuries and basically agree to get like their reserve assets inflated away. And so I think the plan overall, it's articulated, described. I'm somewhat critical of it because I think it overestimates the U.S.'s negotiating position and overestimates the willingness of other large countries to kind of play along with that. But it is, I would say, a semi-realistic picture of kind of, if you were to describe how it would work optimistically, that's kind of how it would go. So that's the plan. And then when you look at the execution, that's where I think it got messier because, they ramped up tariffs super high, super quickly, that in many cases were so high that they hurt us as much as some of our trade adversaries. And even, it takes years to reshore and build a manufacturing base. So if you throw on really high tariffs right away, we pay the consequences right away, but we don't really get the benefits anytime soon. And so other countries like China can just say, well, we'll just wait then because, your tariffs are hurting yourself as much as you're hurting us. And so far, the U.S. has kind of rolled back some of those tariffs. They made exemptions for like Apple and phone makers. They made exemptions for automakers. And the problem there is that you're basically exempting big businesses while little businesses that make all the widgets we don't think about, they have all the uncertainty and all the problems. And so now there's like, groups of small businesses asking for tariff exemptions. And so I think that the overall outcome is that they're not going into the next phase in the negotiating power that Stephen Myron would have, hoped for, I think, as articulated in that paper. So I think when you go from mandate to plan to execution, each step was kind of a little weaker than the prior one.
Welcome to the Market Chronicles. This is our 20th deep dive. And today we're tackling something really crucial, something on a lot of people's minds. What's actually happening with the U.S. dollar as the world's reserve currency?
Yeah, it's a huge topic.
Definitely. We're going to be digging into the analysis of Lyn Alden today. She has some really insightful takes on, trade imbalances, currency dynamics, and where things might be heading.
Her perspective is pretty comprehensive, looking at the big picture forces.
Exactly. And we know many of you are trying to get your heads around these complex global finance trends and figure out, well, how might this all affect us?
Mm-hmm. It connects globally and domestically.
It really does. Oh, and for those of you watching on YouTube, make sure you hit subscribe so you don't miss out on our future explorations into these market forces. Okay, let's get into it.
So a really key idea from Alden is this potential shift towards what she calls a multipolar currency world.
Right. Not like the dollar just vanishing overnight, but a change.
Exactly. More of a regionalization. You might see, say, the Chinese yuan becoming more dominant in East Asia while the dollar holds strong in the Americas and, other key areas.
And the euro in Europe and its sphere, presumably.
Precisely. So it's this gradual rebalancing she's talking about, not a sudden collapse.
And Alden connects this potential shift to what countries might hold in their reserves, right? She talks about neutral assets.
Yeah, echoing some points Stephen Mnuchin also made later. She highlights things like gold and even Bitcoin as potentially becoming more important, sort of neutral reserve assets.
The logic being, if the world isn't quite so centered on one currency,
then maybe you want assets that aren't tied to any single country's policies or economy quite so directly, assets that are more neutral for transactions or just as a store of value.
Makes sense. Which brings us to the core tension. Alden really focuses on this Triffin dilemma with the dollar.
Yeah, the classic problem. To be the world's currency, you kind of have to supply it. And that usually means
running deficits. You have to send more dollars out than you bring in, essentially. But doing that year after year
can eventually make people question the long-term stability. Back in the Bretton Woods era, that pressure showed up as a drain on U.S. gold reserves.
Right. And Alden's argument is that today, in our current system, that cost looks different. It manifests more as a weakening of the U.S. industrial base.
Oh, so?
Well, this huge global need for dollars for trade, contracts, central bank reserves, it creates this extra layer of demand for the dollar itself.
Okay, so it pushes the dollar's value up.
Kind of artificially, yes.
Yeah.
Which sounds good, maybe, but it makes it more expensive for American companies to produce things, especially lower margin goods, and compete globally.
And that global demand for dollars, it's directly fed by the U.S. trade deficit. The main way the world gets the dollars is by selling stuff to the U.S.
So the U.S. imports more than it exports. That's the mechanism. So these dollars go out. But then what happens? Alden points out they come back.
Right, they return as investment. Foreign entities buy U.S. stocks, bonds, real estate.
Which injects capital, sure, but it also means increasing foreign ownership of U.S. assets over time.
And Alden really emphasizes the geographical impact of this inside the U.S. You see economic activity concentrating in, say, coastal financial centers, tech hubs.
While the traditional manufacturing areas, the Rust Belt, feel the decline.
Exactly. And she links this imbalance pretty directly to things like rising voter populism, that feeling you mentioned earlier that the system is somehow rigged or unfair.
So because these trade imbalances have these really significant financial and political ripples,
Alden observes there's this growing mandate, or at least a growing feeling, that something needs to be done, even if people disagree on what should be done.
the idea being it's probably better to try and manage these things proactively from a position of strength rather than wait for a crisis to force your hand.
Yeah, and speaking of managing things, Alden discusses that framework Stephen Mnuchin put out, I think it was late 2024.
Right, his paper on realigning global trade. It acknowledged the Triffin dilemma, acknowledged the dollar might be overvalued.
And it suggested things like maybe some mild targeted tariffs or negotiating currency accords, agreements between countries on exchange rates, perhaps structured to be more favorable to the U.S.
Interestingly, that framework apparently even floated the idea of gradually, deliberately reducing the dollar's primary reserve role.
Alongside boosting the role for those neutral assets we talked about, gold, maybe crypto like Bitcoin.
Of course, weakening the dollar isn't without risks. Inflation, higher borrowing costs for the U.S.
Sure. And the Mnuchin plan reportedly had ideas to counter that, like trying to lock in longer-term government debt at current rates, terming out the debt, they call it.
But Alden expresses some skepticism about this whole plan, doesn't she? Like, how realistic is it?
Yeah, she questions whether the U.S. really has the negotiating leverage it thinks it does, and whether other major countries would actually, go along with it fully.
Which kind of leads into the problems with the execution phase we saw with tariffs more recently.
Right. Alden points out that when tariffs were put in place quickly, broadly, sometimes they ended up hurting the U.S. economy too, not just the trading partners.
And you can't just instantly reshore decades of manufacturing. That takes time, investment.
A lot of time. So the negative effects of tariffs, like higher costs for consumers and businesses, weren't immediately offset by new domestic production.
Plus, the way exemptions were handed out, it seemed inconsistent, maybe favoring bigger companies.
That's a non-point Alden raises, yeah. It diluted the impact and just made things more complex, arguably didn't quite match the neat plan on paper.
Okay, so summing up Lyn Alden's view here, we're looking at a potential, maybe slow, shift towards a more multipolar financial world. This could make neutral assets like gold or Bitcoin more attractive.
And this whole dynamic is tangled up with the basic contradictions of being the world's main reserve currency provider, especially the trade deficits it requires.
Which have real, tangible effects on the U.S. economy domestically and politically, too.
And while there's a push to address those imbalances, the actual strategies and how they're carried out, well, they face some pretty significant challenges.
So that leaves you with a final thought, really. As all these massive global financial gears are grinding and potentially shifting, what does that mean long term for you as an investor, for the global economy?
Yeah, how does the U.S. navigate this complex landscape going forward? It's definitely a story that's still unfolding.